Have you ever wondered how a political event in one part of the world can affect economies on a global scale? Geopolitical risks are potential threats to normal political activities within a nation or between nations. They encompass a broad range of issues from military conflicts to diplomatic disagreements and even trade disputes. These risks, while often localized, can ripple out and make waves in the global economy. Take, for instance, Russia's invasion of Ukraine. A military conflict, yes, but its implications extend far beyond the battlefield. When tensions rise and uncertainty looms, the gears of the global economy start to grind. Now you might be asking, how does a geopolitical risk in one part of the world lead to economic changes globally? Good question. Here's how. When geopolitical risks escalate, they can cause a reduction in global gross domestic product or GDP. GDP is essentially the total value of everything produced by all the people and companies in the world. So when we say geopolitical risks can lead to a reduction in global GDP, we're saying that these risks can cause a slowdown in the production of goods and services worldwide. But it's not just about production. Geopolitical risks can also lead to an increase in global inflation. Inflation is the rate at which the general level of prices for goods and services is rising. When geopolitical risks rise, so too can inflation. This can happen if, for example, a conflict disrupts the supply of a crucial resource, causing its price to skyrocket. So as we see, geopolitical risks can have far-reaching effects beyond their immediate location. They can slow down the global economy and even make your groceries more expensive. And that's just the tip of the iceberg. Tune in for the next scene, where we'll delve into how we measure these geopolitical risks. But how do we measure something as complex and varied as geopolitical risks, you might ask? Well, the answer to that question is more intriguing than you might imagine. To get a handle on these risks, experts have devised two measures based on textual analysis of newspaper articles and firms' earnings calls. It's a bit like reading the tea leaves, but with a lot more data and a lot less mysticism. The first measure, drawn from newspaper articles, is a fascinating exercise in big data. Think of it as a giant word search. Analysts scour thousands of articles looking for keywords that signal geopolitical risk. These could be words like conflict, war, sanction, or crisis. By tracking how frequently these words appear and where they appear, analysts can create a picture of geopolitical risk as it ebbs and flows over time. The second measure, derived from firms' earnings calls, is a little more direct. Here, analysts listen in on the conversations of big businesses as they discuss their earnings and prospects. If these firms start talking about geopolitical risks, it's a pretty clear sign that these risks are on the rise. With these two measures, analysts are then able to construct an index of geopolitical risk. This index, like the measures that feed into it, changes over time. It captures the ups and downs, the peaks and troughs of geopolitical risk in a way that allows us to quantify what might otherwise seem unquantifiable. And it's not just a single monolithic index, it also has subcomponents. These allow analysts to drill down further to see how different types of geopolitical risks are evolving. There might be a subcomponent for military conflicts, another for economic sanctions, and yet another for political crises. In essence, these measures, and the index they feed into, provide us with a unique lens through which to view the world. They offer a data-driven, quantifiable perspective on the swirling, shifting landscape of geopolitical risk. So while the task of measuring geopolitical risks might seem daunting, it's not an impossible one. Thanks to the power of data and the ingenuity of analysts, we can make sense of the complex and varied world of geopolitical risks. These measures provide us with a way to quantify the seemingly unquantifiable. Now that we understand how to measure geopolitical risks, let's delve into the specifics of their effects. Geopolitical risks, as we've learned, are pervasive and can have far-reaching impacts on the global economy. But these impacts aren't uniformly distributed. Different economies and industries can experience these effects in varying degrees and manners. Take, for instance, the European economies. These are often more susceptible to geopolitical risks due to their geographic proximity to many of the world's conflict zones. Additionally, the interconnection of European economies means that a shock in one country can quickly spread across the continent. As a result, an increase in geopolitical risks can lead to significant reductions in the GDP of these economies. But it's not just about geographical location. The type of industry also plays a crucial role in determining the level of impact. Goods-producing industries are particularly vulnerable. These industries rely heavily on stable supply chains, which can be disrupted by geopolitical tensions. The result? Production slowdowns, increased costs, and ultimately a decrease in global output. Furthermore, these industries often operate on thin margins, meaning that even a slight increase in costs or decrease in demand can have significant impacts on profitability. This, in turn, can lead to job losses and further economic instability. In contrast, service-based industries, while not immune, may be somewhat more insulated from these risks. Their operations are often less tied to physical assets that can be directly affected by geopolitical events, and they can sometimes even benefit from the increased demand for certain services during times of uncertainty. But regardless of the type of economy or industry, the effects of geopolitical risks are rarely contained. They ripple out, affecting everything from the price of goods in your local store to the value of your investments. In short, while geopolitical risks are a global phenomenon, their impacts are local and sector-specific. The economic landscape is a complex and interconnected web, and when one thread is pulled, the entire web can shift. The ripple effects of geopolitical risks are not evenly distributed, with some areas and sectors being hit harder than others. So how exactly do these geopolitical risks translate into economic impact? Let's dive into the channels through which geopolitical risks can impact the economy, shall we? First off is the disruption of trade flows. When geopolitical tensions rise, trade barriers often follow. These can be in the form of tariffs, embargoes, or even outright bans. For instance, if a country involved in a geopolitical conflict is a major exporter of a certain commodity, the trade disruption can lead to a shortage of that commodity worldwide, driving up prices and causing inflation. The second channel is through financial markets. Geopolitical risks can cause instability and uncertainty in the global financial markets. Investors, both domestic and international, may shy away from investing in regions embroiled in conflict, leading to capital flight. This can result in a drop in the value of the country's currency and a rise in interest rates, affecting the overall health of the economy. Another channel is through changes in energy prices. If the conflict involves countries that are major producers of energy resources, such as oil or gas, it could lead to significant price fluctuations. An increase in energy prices can have a domino effect on the costs of production and transportation, impacting industries far and wide. Lastly, geopolitical risks can also impact migration patterns. In times of conflict, people are often forced to leave their homes and migrate to safer regions. This mass migration can put pressure on the resources of the host countries, potentially leading to social and economic challenges. So, you see, geopolitical risks are not just about politics or military conflicts. They have wide-ranging effects that ripple through various channels, impacting economies globally. They can disrupt trade, affect financial markets, cause energy price fluctuations, and even change migration patterns. Through these channels, geopolitical risks can infiltrate and influence economies in ways you might not expect. We've covered a lot of ground today, so let's take a moment to recap. Our journey started with a deep dive into the world of geopolitical risks, exploring its influence on the global economy. We learned that these risks, sparked by events like Russia's invasion of Ukraine, can have wide-reaching effects, contributing to a reduction in global GDP and a surge in global inflation. Next, we moved on to the intriguing task of measuring these geopolitical risks. Using tools like textual analysis of newspaper articles and firms' earnings calls, we can quantify the increase in these risks. This allows us to gauge their potential impact, making the abstract concept of geopolitical risk a little more tangible. We then delved into the differential effects of these risks on various economies and industries. European economies and goods-producing sectors, we discovered, are often hit the hardest. This understanding helps us anticipate and mitigate the adverse effects of geopolitical risks in these vulnerable areas. Lastly, we explored the channels through which these risks can impact the economy. It's not just a direct hit. These risks can ripple through the economy, impacting sectors and countries far removed from the original event. This multi-layered impact further underscores the significance of geopolitical risks. So the next time you hear about a political event on the news, remember that its effects could be felt far beyond its borders, in economies around the world.